Hello and welcome to Business Today Television. I'm Siddharth Zarabi and with me today is N.S. Venkatesh, the Chief Executive Officer of the Association of Mutual Funds Industry of India, AMFI. Welcome uh, uh, to BTTV, Mr. Venkatesh. I want you to begin by telling our viewers about the latest data as far as inflows into the mutual fund sector in the reporting month of April.
Thanks, Siddharth. Yeah, essentially, if you are looking at it, the flows have been reasonably okay in the sense that the net flows for this month is around 1,21,000 crore. The AUM is at around 41 lakh crores compared to 40 lakh crores in March. Uh, there is growth, upward trending growth in the mutual fund industry. Most of the flows had come in the open-ended debt equity schemes, and it is essentially around 65,000 crore coming into the liquid funds, then some 10,000 crore into the overnight funds, and another 10,000 crore into the money market mutual funds. And then on the debt side, all other debt funds are also seeing some positive flows. On the equity side, there's a net equity flow of around 6,000 and odd crores. Compared to March, it is less. March it was at around 12,000 crore. Now it is at around 6,000 crore. I would say that the debt flows, especially the liquid, overnight, and money market, is mainly because of the treasury management exercise of the corporates as well as the banking system. So that keeps on going up and down depending upon their cash requirements emanating out of the advance tax payments or capital adequacy purposes. Otherwise, the short duration fund and the medium duration funds are also seeing positive flows despite the what we saw about the income tax tweak on the capital gains, which is a good sign. So I personally believe that the investors have understood that we need to look at the post-tax yield, and the yield has really peaked at this particular point of time when Reserve Bank of India has paused its repo rate hike. So people are trying to take advantage of that and putting it money in the medium, short, and long duration funds. So overall, I would say it was a good month for the mutual fund industry.
One of the points that the data seems to suggest is that small cap saw the highest level of investment, while large cap was very low. And this, like you said, 26 straight months of positive inflows for equity mutual fund. But what explains this divergence between small cap and large cap?
That is essentially due to the fact that the small caps had undergone a steep correction in valuation when the market fell. And so now the investors are believing that they will see a value addition by investing into the small cap funds and mid cap funds. So that is where you are seeing more money coming into the small cap and mid cap. But the large cap is also performing, in the sense that large cap is giving a steady return. So to that much extent, money people are still seeing value in investing in the large cap. More value they see in the mid cap and small cap, for the simple reason the valuations have corrected steeply.
Mr. Venkatesh, what's the outlook for the month of May?
The outlook for the month of May, we believe, is that the SIP flows will retrace the 14,000 crore which we saw in March. We will climb that peak once more. And during the month of May, we will see more flows coming into the equity, because equity markets will do better with the earnings season showing good earnings by the corporates. So I would see the equity flows coming up, and some money coming into the debt flows in the long duration and medium duration funds, for the simple reason that the interest rate cycle has peaked. So overall, I would say May will be a good month for the mutual fund industry.
Mr. Venkatesh, you touched upon this point briefly. I just want you to explain it further. The tax SOP removal, you said that has not really hit the inflows as far as debt funds are concerned. But longer term, do you see changes in investor behavior, and is there also going to be a continuing challenge for the industry when it comes to products?
Essentially, if you see from the taxation angle, the capital gains tax has been tweaked in the sense for the debt funds. So, which people initially, on a knee-jerk reaction, took out some money, but now they understood that look at the post-tax yield. So, when they are looking at the post-tax yield plus the convenience of, let us say, a redemption being made today and money getting tomorrow, so liquidity is also there. And if you look at the premature payment penalty which the banks levy on the FD, which is not there in the mutual funds debt segment. So if you look at it from that angle, the people are now saying that it's better to look at the post-tax yield with this convenience, and they are saying that it's better to stay invested into the debt funds. That is why you saw some money coming back into the debt funds, and going ahead, we will see the high net worth individuals and ultra high net worth individuals continue to remain invested into the debt funds.
Soon after the budget, where this tweak was made, there were some reports suggesting that the mutual fund industry would discuss and work with the government on this specific aspect. Did anything come of that?
No, we nothing has come up at this moment. We had definitely written to the regulator as well as to the government, saying that these are all long-term investments and for the benefit of the development of the capital market and also for the benefit of the industry and the economy as a whole. These long-term resources should be encouraged. But as at this particular point of time, we have not received anything from the government.
Uh, I just want to shift the focus to trends, a point that just came up now. Millennial investors, and we have seen a very significant chunk of them come into the broader markets over the last 2-3 years. What are they up to as far as mutual funds are concerned?
Over the last 5 years, the millennials have started heavily investing into the mutual funds, and the studies have indicated that the millennials are showing greater interest in coming into the mutual funds as a investment vehicle, and they have invested directly as well as through the mutual fund distributors. But over a period of time, we see that the mutual fund distributors have played a major role in bringing the millennials into the mutual fund investment route. So we believe that the millennials will continue to remain invested, and the numbers are bound to go up only because they have disposable income at their hands, and that disposable income they would definitely start investing a part of that into the mutual fund.
There was a recent Sebi study which said close to 90%, 89% traders basically witness losses. Uh, Given that data, what would you say to those who are watching this program as far as uh, doing a systematic SIP by SIP kind of investment versus day trading?
Essentially, the losses which you are alluding to, which essentially SEBI has been warning the investors, is that relating to the leverage instruments like the futures and options and all those things. And there the investors have lost money heavily because they have not understood the product and its risk profiles and the complexities of those products. But if you look at the mutual fund, it is a straightforward and a simple product of investing and creating wealth. So we would suggest that those investors should look at mutual funds much more closely and start investing into the mutual funds, which is a very time tested sort of an investment vehicle, where and at a low cost sort of vehicle where people create wealth out of investing into the mutual fund. So I'm quite sure that the persons who have lost money in the futures and options will now move away from those sort of instruments and come back to very plain vanilla instruments, including the mutual funds.
Well, that would be definitely good for safe investing. Before we wind up this conversation, Mr. Venkatesh, a broader question once again, and this is to do with India really being a fixed deposit nation. Now, decades and years have passed, there have been changes, and the preference for fixed deposits stays. What's your own sense? Is there a tipping point likely, although the absolute numbers don't seem to suggest that will happen anytime soon? but the preference for fixed deposit versus, like you described, liquid mutual fund investment.
The banking deposits in the last couple of years have been growing at somewhere around 11%. If you look at the mutual funds have been growing at somewhere around 16-17%. So the gap is there, where essentially 6-7% gap is there. If this continues over a longer period of time, we should come to a sort of a situation where essentially the mutual funds will be a major chunk in the BFSI sector. Anecdotally, if you are asking me, I would say that when the SVB, Silicon Valley Bank, had sort of gone into default sort of thing, the people had withdrawn their FDs, and that FDs had actually gone to the money market mutual funds. So people will understand that it is better to put money in mutual funds because they have the safety, they have the liquidity, they have the returns. So I would say the three basic concepts of any investment of SLR principle means in a mutual fund investment. So I'm quite sure that the mutual fund industry will get its fair share. The deposit growth in the banking sector with their numerous branches, retail outlets being very near the customer could push the deposit product, but the mutual fund products are catching up fast.
Absolutely, and that catch up, regardless of what an investor decides to do, I would like to say is perhaps going to pan out in the years to come, because SIPs are all about saving, investing, and prospering. That's my definition of an SIP, Mr. Venkatesh. Thank you very much for your time with us today. See you sometime soon again. Till then, goodbye.
Thank you.
If you like the video, do like, comment, share and subscribe.